You've heard it 1,000 times. Buy stocks. The market's up. I bought shares in that company. But if someone stopped you right now and asked, what is a stock actually? Could you explain it? Most people can't. And that's not your fault. Nobody ever really sat you down and spelled it out. So let's fix that. In the next few minutes, you'll understand exactly what a stock is. No jargon, no finance degree required. Here's the whole idea in one sentence. A stock is a small piece of ownership in a company. That's it. When you buy a share of a company, you're not lending it money and you're not buying its products. You're buying a tiny slice of the company itself. You become a part owner. A very small one, but a real one. Let's make that concrete. Imagine a company, we'll call it Acme, is like one giant pizza. To raise money, Acme cuts that pizza into 1,000,000 identical slices. Each slice is one share. Buy one share and you own one slice of the whole company. 1/1,000,000th of everything Acme owns and everything it earns. Buy 10,000 shares and you own 1% of the entire company. Same pizza, just a bigger plate. That's all it means when people say a company has 1,000,000 shares. It's how many slices the company was cut into. So why would a company sell off slices of itself in the first place? One word: money. Growing a business is expensive. You have to hire people, build things, launch products. Instead of borrowing it all from a bank, a company can sell pieces of itself to the public and raise cash it never has to pay back. In exchange, the buyers, people like you, get to own a piece and share in whatever the company becomes. The company gets fuel to grow. You get a stake in the ride. Okay, so why would you want a slice? Owning a share can do 3 things for you. First, a claim on profits. When a company makes money, it can pay some of it back to its owners as a dividend. Basically, a thank you check just for holding the stock. Second, a vote. Shareholders get a say in big decisions like who runs the company. And third, the big one, growth. If the company becomes more valuable over time, your slice becomes more valuable too. That third part is where most of the action is, so let's be honest about it. The price of a share goes up and down every day based on what people think the company is worth. Say you buy a share for $50 and the company does well. Maybe it's worth $80 later. Your slice just gained $30. But here's the catch. That gain isn't real money until you sell. Until then, it's just a number on a screen. And it can go the other way just as easily. If the company struggles, that $50 share might be worth $30. Stocks can grow your money, and they can lose it. That's the trade-off for owning a piece of the upside. And here's something that surprises people. You might already own stocks without realizing it. If you've got a retirement account through work, like a 401k, there's a good chance it's quietly buying shares of hundreds of companies on your behalf. So this isn't some far-off Wall Street thing for rich people. If you have a paycheck and a retirement plan, you may already be a part owner of some of the biggest companies on earth. Now that the idea clicks, let's lock in the words you'll hear everywhere. A share is one single slice, one unit of stock. A shareholder is anyone who owns at least one. Equity is just a fancier word for ownership. If someone says they have equity in a company, they mean they own part of it. And a dividend, like we said, is a slice of the profits paid back to owners. 4 words, and you already understand all of them. So here's the whole thing in one breath. A stock is a small piece of a company you can buy. Companies sell those pieces to raise money. You buy them to own a stake, to earn a share of the profits, get a vote, and grow along with the company, knowing the price can fall as well as rise. That's a stock. Not so mysterious after all. If this made it click, that's exactly what this channel is for. Stick around, and we'll turn the next confusing thing into something simple too.